Okay, friends, let us continue discussing case scenario number 7. HHM and Co. is a famous consultant, has been established the following strategy on the stock of PLS Limited. Purchase one 3-month call option with a premium of 25 and an exercise price of 750. Purchase one 3-month put with a premium of 8 and an exercise price of 600. This topic comes under option strategy, strategy I will have discussed in the class. Okay, now the stock price of PL Limited is currently sitting at 680. The option size is 100 shares. And from the following information, all these, what is the net gain or loss if the price of the stock remains at 680 after 3 months? Now, net gain or loss. Now, what you should do, premium you should consider and reduce the premium also. So, what we see is that in this question, you have taken two options. You have also taken a call option and you have also taken a put option. Okay. Now, here, for call option, how much premium you have paid? 25 rupees you have paid a premium. For put option, you have paid a premium of 8, which means 25 into 100. The lot size is 100. So how much is this? 2,500 for the call option. For the put option, what is the total premium? This is, I'm considering just the premium. For the put option, 8 into 100, okay, equal to C. What happens? Price of the stock remains 680. What is this? A future spot price. Maturity date, spot price. FSP. I call it as FSP in our class. Future spot price is 680. Okay. Now, first, call option. An option worth 680. Call option exercisable at 750. Will you exercise a lapse? Okay. Will you exercise? No. Because 680 available in the open market. Why would you pay 750 and exercise the right to buy? You have purchased, na? No. So, what you should do? You should just lapse. You will lapse with regards to call option. Next, payoff is nil. Next, come to the put option. Put option. What happens? A share worth 680, exercisable at, which means saleable at 600. Will you sell? You will not sell. That also I think is loss. So 2,500 plus 800. This is premium. You have bought both the call and put. Yes, both the purchase. See here, purchased. Here also you purchased, which means you would have paid a premium as a call holder and put holder. How much is the total premium you paid? 3,300. So net loss of 3,300. Are you all understanding? So one should be the A should be the solution. It out. Scenario number 7. Yes, A is the solution. Are you all understanding? Next case scenario. Next question number 2. What is the net gain or loss if the price of the stock falls to 500 after 3 months? Same situation. Just this is nothing but FSP. Future spot price become 500. What is the payoff? See what happens. You tell me. 500, an option, call option worth 500, exercisable, right to buy, exercisable at 750. Will you exercise? Will you lapse? Lapse. Yes. Not an issue. Next, put option, a share worth 500, saleable at 600. Will you sell? Yes, I would like to exercise my right to sell because higher price I can sell now. So 600 minus 100, how much is that? 100 is the profit into how many shares? 100. So how much is that? 10,000 will be the profit. Okay, here from the payoff it will be profit, but premium, how much is the total premium minus the premium paid? This is the profit payoff from the call and put option benefit minus premium you would have paid. How much is that? 3,300. If I reduce this, what is that? Net gain of how much? 6,700. Net gain of 6,700. C should be the right answer. Okay, yes, C is the right answer. Next. Case scenario, this is number 3. What is the question number 3? What is the net gain or loss if the price of the stock rises to 820? A share worth 820, exercisable at, what is the call option? 750. Will you exercise? Yes, I will exercise. I will exercise. And what is the gain? 820 minus 750. Exercise price of the call option. Okay, I have a right to sell at higher price. Now I will exercise. How much I will earn? 70 rupees is the gain per share into 100 is the lot size. How much is that? 7,000 is the gain. From call option. Now let us put option, exercise price 600, a share worth 820. Why would I exercise my right and sell at 600? I would never exercise. I will lapse it. So gain, total gain is 7,000 from both the call and put minus premium paid for both combined is 3,300. How much is that? 7,000 minus 1,300. Gain of 3,700. 3,700. Net gain of 3,700. Okay. Next. Case scenario number 8. On 3rd April 2025, Royal Bank quotes the following: spot exchange rate 84.2525, 85.594. Ask. 2 month swap points given for bid as well as ask. 3 month swap points given 150 and 170. Now, see, I told you the swap points may be same for bid or offer. It may be also different. It will be given in the question. You have to take as per the data given. Now, In a spot, this question is regarding finding the forward rate using swap points. Using swap points, ascending swap means you will add to the spot rate. To find out the forward rate, you will add the ascending swap. See, first step. What is the first step? See whether the swap points are ascending or descending. 60 and 80, ascending or descending? Ascending. Okay, next 150, 178. Both the swap points are ascending swap points. So swap premium, which means forward is trading at premium. Are you all understanding? Now, will you add a subtract a add? Ascending swap means you add a descending swap means you will reduce from the spot price to arrive at a forward rate. Are you all understanding? So what you should do? Ditto same question. Ditto 2.5 months here. Yes, they are asked. See what the question asked. First we will read out the question. Ditto question is available in our classroom segment of the workbook, which you used to do in the class itself. Okay. In a spot transaction, delivery is made after 2 days. Assume spot date as 5th April 25 and one swap point, 0.0, obviously 4 digit given in the spot rate, you will consider as to 0.00001. Calculate up to 4 dozen, not an issue here. Now see, assume spot date as of 5th April is this much, which means even though, see here, spot exchange rate on 3rd April we have given like this, but still you will assume that this spot rate, okay, spot date is 5th April, right? No issue. Now what they're asking, the swap points for 2 months and 15 days. Remember, we did one question, okay, 2 months and 15 days, which means they have given the data regarding 2 months rate, okay, swap points, 3 months swap points. What you should do, see, you require a forward rate for 2.5 months, not fully 3 months, which means can you add this 3 month swap straight away to the spot? You cannot add. What will you do? Okay, you should add the 2 month swap points fully. Thereafter, okay, this is 2 month swap points, this is 3 month swap point. What is the differential amount? See, 150 minus 60. What is this? 90. Here, 178, 3 month swap points minus 2 month swap points. How much is that? 178 minus 98. So these two are the swap points for the particular 3rd month alone. 1 month after a period of 2 months. Are you all understanding? So 2 month swap points will straight away add from the spot. Thereafter, you have 1 more month swap points, which I got it as 90, 98. Interpolate it, okay, because 15 days exactly comes in between that, divided by 2 and add it to the spot rate. Are you all understanding what to do? Okay, see, very simple. I'll tell you what to do. First, to tell me what is the spot rate for bid. See here, spot, bid, ask. Ask also can be written as offer. Both are same. Don't get confused. Sometimes, okay, ask is used. Sometimes offer rate is. See, ask is that then you have 2 months swap on 60 and 80. I'll add, because ascending swap, I'll add 60 and 80. Sorry, 1 second. First, let me write the swap bid and ask. What is the amount? 84.2525. 84.252. Then ask is how much? 85.594. 85.594. Now what I do? This is spot. Now plus I add for premium bid or ask. First 2 months I'll add. What is that? 60 and 80. So straight away 60 and 80. Now see here 0.0060. They have told now 0.0060. Anyway, next this is the swap point. Next I will add what I do. I add the differential amount for 15 days after a period of 2 months. So 2 months, this is the rate, 3 months. This is 90 and 98. I will take half interpolation. I'll do for 15 days. For 1 month, this is 90 and 98. For 15 days, 90 divided by 2. How much is that? 45. Okay, 0.0045. And here 0.0098. What was the number? 98 divided by 2. That 49.049. Are you all understanding? I'll add up everything. I'll get the rate. Now, what they're asking, the swap points for 2 months and 15 days will be, see. Now, the swap points for 2 months and 15 days, which you need to add it in total, which means they're asking the cumulative, this number. Okay, 60 plus 45. What is the number? 60 plus 45, 105. Okay, this is 105. Then 60 plus 49. Okay, 129. Are you all comfortable? B should be the solution. Next, foreign exchange rate for 20th June will be. Now they are asking us to, okay, add up everything, find out the forward rate for 20th June. Tell me, children, what you should do? This 90, this 105, 0.015. So 84.2525 plus 0.005. How much is that? 84.263. 84.2 bid rate. Offer rate, you add 129 now, 0.0129. 85.5945 plus 0.0129. How much is the number? 85.6074. Let us check it out. 63, 84.263, 6074. C is the solution. Yeah, question number 3 here. On an average rate, the annual rate of premium discount of US dollar on Indian rupee will be, okay, bid, ask, They've given all these options. Let us see. See here, important observation is that average rate, okay, which means for bid rate, you will have a spot rate and forward rate. Okay, generally what will happen, I'll tell you. What happens is the premium or discount percentage, forward premium is equal to forward rate minus spot rate divided by spot rate we take. You're understanding? But in this question, they are specifically asking us to take average rate, which means spot rate, simple average you will consider, plus forward rate divided by 2. The denominator will undergo a change. Are you understanding? So forward rate minus spot rate will give you premium in terms of amount. So this is premium. Okay, this is premium divided by simple average rate, which means spot rate plus spot bid rate plus forward bid rate divided by 2. You'll get the average bid rate. Then premium divided by average bid rate will give you premium for bid. Then ask rate separately will consider premium. That also average rate will find out. Are you all understanding? Simple calculation. Let us see. Okay, verify this. See, you have both the spot bid. This is spot bid. This is forward bid. This is forward bid rate. Forward ask. Now, see, what is the forward rate? 84.263 minus 84.2525. This is the differential amount, which is nothing but 105, 0.0105, or I can simply put it 0.0105, which already found out, divided by simple average, which means 84.2525. Take your calculator. 84.2525 plus 84.63 divided by 2. What is that? 84.2577 divided by 84.5775.0. This number into 12 by 2.5, because this is annualized percentage they are asking. Now you have to annualize it. This is forward rate for 3 months. Okay, if it is for 2.5 months, if it is for 2.5 months, you have to compound it. Okay, which means you have to multiply into 12 by 2.5 into 100 percentage terms to find out. Understand? Let us find out what is it. 0.0105 divided by 84.577 into 12 divided by 2.5 into 100. 5.981, 5.98 percentage. That is what they have rounded. But here two given solution is this discount. I will just slash it out because premium na. So bid 0.0598. I don't need to even compute because the only option unique option. But still we will compute to get the practice. Please tell me what is the next number. Ask rate we need to find out na. So first average. What is the differential amount? I already know that 0.0129 na. 0.0129 divided by this simple average 85. 5945 minus plus 85.074 divided by 2. How much is that? 85.00. Right? Anyway, 85.6. I can just 0.012 divided by 85. Getting anyway into 12 by 2.5 into 0.07233. Are you all getting this point? Rounding off the solution. Next, take case scenario number. ABC Limited is planning to acquire XYZ Limited. The following information is available in this respect. ABC Limited, number of shares given, market price per share, PE ratio, mergers and acquisition, simple, straightforward question. Okay, 4 lakhs 20, PE ratio is 10 times. Anyway, ABC plans to acquire the whole of XYZ Limited by issuing shares at its market price of 16. It is expected that the price of ABC Limited will remain constant. This is important. Okay, it will remain constant after acquisition. Purchase consideration 80 lakhs, calculate up to 2 decimal solution. Now, EPS of ABC Limited and XYZ Limited before acquisition respectively. So acquisition not happened before acquisition, find out the EPS. EPS is nothing but here MPS divided by PE ratio. Okay, you can just simply do the MPS divided by PE ratio. 16 they have given. Before acquisition, MPS is 16 divided by PE 20. 0.8 for ABC Limited, then 2 for XYZ Limited. Obviously 0.8 and 2. A should be the solution. Case scenario 9. Okay, A should be the solution. See. Yes, 16 by 20, 20 by 10. Simple and straightforward. Next. EPS of ABC Limited after acquisition. After acquisition, what is the EPS? See, what happens after acquisition, I'll tell you. First, what is the post-acquisition EPS of ABC Limited, which is acquiring? Yes, ABC Limited is acquiring, which means post the merger EPS now, very simple. Then what is the existing EPS? 12 lakhs. You have existing number of shares, which means very simple. What is post? First, post acquisition EPS is equal to total earnings. Okay, which means earnings of ABC Limited plus XYZ Limited divided by number of shares after acquisition of a acquisition, number of stand outstanding of ABC after acquisition of the XYZ. Okay, number of shares of the merged entity. Now, total gains, total earnings you need to find out now. First, you need to find out the individual earnings. What is the individual earnings totally? 16 is there, 20. What is the EPS? See, very simple. I'll put it like this. ABC Limited. Okay, and you have XYE Limited. Okay. ABC Limited EPS was 0.8 into number of shares outstanding. How many shares are outstanding for ABC Limited? 12 lakh shares. About 12 lakh into 0.8. How much is that? 9,60,000 will be the earnings. 60,000 will be the earnings of ABC Limited. And XYZ Limited, see, before, what is the earnings? What is the earnings? 2 per share. How many shares outstanding? 4 lakhs. So 4 lakhs into 2 per share. 8 lakhs is the earnings. Now, total earnings. Synergy given in the question or not given or not given. So this will be the total earnings. Comes to 17,60,000 of the merged entity divided by number of shares, the existing number of shares of ABC plus new shares issued for taking over the company. The new shares, you need to find out the exchange ratio. Okay, how many new shares will be issued? Now, generally not given in the question. Market price, now you will consider only market price unless otherwise stated in the question regarding exchange ratio. So market price is given, which means XYZ Limited market price is 20 rupees. Here it is 16 rupees. Okay, you will offer, see, you will pay 20 rupees and receive 16, which means effectively 20 by 16. 20 divided by 16. MPS of the, okay, acquired company divided by MPS of the acquiring company or purchasing company. How much is that? 1.25. 20 by 16 is the exchange ratio, 1.25, which means for every 1 share of XYZ Limited, ABC Limited will give 1.25 of its own shares, which means total 4 lakh shares are there in XYZ Limited. For that, into 1.25, 5 lakh shares will be issued by ABC Limited. Are you understanding in exchange? So 5 lakh shares will be there. Existing 12 lakh shares. Totally 17 lakh shares. Total earnings 17 lakh 60,000 divided by 17 lakh shares. How much is that? 17 divided by 17 lakhs comes to 1.03529. No option is available, which means 1.04 should be taken. 0.04. Are you all understanding? This is the correct solution. Are you all understanding? In a rounding off issue, they have rounded off to next number, 0.04. Next. Question number 3. P ratio of ABC Limited after acquisition. P ratio of ABC Limited after acquisition is how many times? See what they have told. MPS of ABC Limited after acquisition will remain same. I highlighted na. It will be same as 16. They have told it. So MPS is 16. EPS is how much? You already calculated. Post-merger EPS. How much is that? 1.04. Okay, MPS divided P ratio is what? Post-merger P ratio is nothing but post-merger MPS divided by post-merger EPS. How much is that? 6 divided by 1.04. Okay, 15.38 is the correct solution. Next, moving on to the case scenario number 10. A and B are two friends. Since B has earned a lot of profit from trading in financial derivative market, A is considering speculating on G Limited shares, which is currently trading at 1,400 per share through taking positions, options in stocks of same company. Okay. Now, accordingly, A took following contract positions in the option of G Limited stock. Selling one contract of 2-month call option with a premium of 70 and an exercise price of this much. Purchasing, this is very important. Here it is selling. Here it is purchasing, which means, okay. See, here is buyer of the call option. Here is seller, okay, of the call. What is that? Purchasing, okay, sorry. I wrote it differently. Here is selling the call option, which means writer, call writer. Here is buying the call option, purchasing the call option, right? Purchasing one contract of 2-month put option. Okay, anyway, purchasing of the put option. See, with a premium of 50 and an exercise price of 1,200. Right. See, here, call option. So, two things is there. One, call option selling. Okay. Two, put option buying. Two things he has done. Are you understanding? Exercise price different for call and put as well as the premium. Now, from the given question, find out the assume that the contract size of option contract size is 200 and the price of G Limited share after 2 months falls to 1,100 and the net payoff of A will be, say, what is the FSP? This is nothing but FSP. Simple, straightforward question. Already we did similar type of question. Straddle and strangle, different strategy. That's it. FSP future spot price is how much? 1,100. A share worth 1,100. You have two options. Call option you have sold. So you will not decide whether you are exercising or not. The holder will decide. Okay, a share worth 1100, exercisable 1500, holder will decide to lapse. Are you understanding? Holder will decide to lapse. You will get the premium as the income. What is the premium income? How much is the income? 70 here income. Are you understanding? So what you will get is a 70 into 200. How much is the 70? 200 into 70, 14,000. Yes, 14,000 will be the total premium income received. Next. See, you have also purchased a put option, right to sell. Right to sell at 1200. You have share worth 1100. Will you sell? Yes, I will sell. In that case, I will gain. Yes, this is the gain here. Here there will be a gain from put option also. What is that? 100 K into 200. What is that? 20,000. 2,000. 20,000. Apart from that, premium. Here you have received a premium. Payoff is nil. Here, this is the payoff. So premium you should reduce. What is the premium amount? Okay, what is the premium amount? You will receive a pay, you are buyer, you will pay. How much is the premium for put option? 50 rupees. 50 into 200? 200 into 50, 10,000. So net payoff will be how much? 14,000 plus 20,000 minus 10,000. 10 plus 14, 24,000. Profit or loss? Profit, because both are gain. So 24,000. Profit should be the solution. 1B, question number 10. Okay, 1B is the solution. Are you all comfortable? Next. The price per price of G Limited stock, okay, share price after 2 months, this is FSP, at which A will be at break even. Very, very important question. Institute has mistaken this question. Okay, very, very important. This I am highlighting because you need to understand. Break even FSP, okay, they're tested in the Jan 26 paper also. Okay, they have never tested these kind of questions usually. But from Jan question paper, they have tested it. But we used to conduct all this in regular lecture. Regular lecture, everything we used to cover. Okay, anyway, they have tested for 2 or 3 marks in Jan 26 paper. In 8 marks option question, they have tested it for 2 or 3 marks. Anyway, now what is the break-even FSP? Very simple. First thing, how to find it. See, break-even point is there. What is break-even point? You need to understand. The break-even FSP, it is nothing but a FSP level, future spot price, at which the call option buyer as well as the call option seller, for call option as well as the put option. Let us see what happens for call option. You have 2 different options now. This is call option. This is put option. Okay. I'll tell you what happens and how this question is different. There are 2 options, call option and put option. Let's take only call option. Call option also you can be a buyer or seller. Here also put option, a buyer will be there, seller will be there. What is break-even FSP? The break-even point is nothing but the future spot price at which both the buyer and the seller will be having the payoff as 0, net payoff as 0. Are you all understanding? Both the buyer as well as seller will be having the net payoff as 0. This is I call it as break-even FSP, which means neither the buyer loses nor the seller loses or gains. No loss, no gain for both buyer as well as seller. So we will have a break-even FSP. Okay, break-even FSP for call option and the break-even FSP for put option as well. Now, I'll explain the formula first for break-even call option and put option. Here there is a combination for call and put, how to find out the break-even FSP. That also I'll discuss. See, new concept hence I'm discussing. Here what you should do, break-even FSP. Okay, let's say what happens. Break-even FSP for call option is nothing but strike price plus premium. Strike price plus premium. Are you all understanding? And break-even FSP for put option is nothing but strike price minus premium. Are you all comfortable? Let me just explain you. Very simple. Now what happens? This is the formula for it. I don't want to get into detail of it. Understand that break-even FSP, strike price for premium. I'll just give you an example. Very simple. See this question. Leave this question alone. Let's say we have taken a call option. Buyer will be there. Seller will be there. Call option strike price is 500 rupees. Strike price is 500. Premium is 60 rupees. Assume just a random number. And the future spot price we need to find out. FSP, break-even FSP, we need to find out FSP at which buyer as well as seller will have net payoff as 0. Shall we compute? See what happens. If you see this, what is the buyer? What is the break-even FSP for call option? X plus premium. How much is that? 560. 560. Let us check it out. At this FSP, let us check it, verify whether we are getting the same payoff. Shall we? As a buyer, a share worth 560, exercisable at 500. Are you all understanding? Exercise price is 500. Right to buy at 500. The share is worth 560. Will you exercise as a buyer? Yes, I will exercise. What is the gain? 560 minus 500, which will be 60. 60 rupees gain. But as a buyer, I have to pay the premium also. This is the gain from the option minus the premium. How much is the premium? 60 rupees. So 60 minus 60, 0. Net payoff will be 0. Come to the, come to selling. Seller, what will be his gain or loss? See, since he will exercise, he will have a loss. Yes, he will have to bear a loss of 60 rupees. Are you all understanding? And he will receive a premium of 60 rupees. Net payoff is 0. Are you all understanding the concept of break-even FSP? Okay, this is strike price plus premium. This I don't want to explain. Again, you can try it out. This is strike price minus premium will be the break-even FSP for put option. Now, how this question is unique, I'll tell you. How this question is different, I'll tell you. There is a combination. This is a strategy. There is a combination of call and put option. Now, as a buyer and as well as seller, very simple. You have taken a put option. Yes. You have taken, here I am telling, call option. With regards to call option, you are a seller. As a seller, you will receive premium. You will receive premium. Okay. As a buyer, okay, you have to pay premium. You have to pay premium. Now, what you need to do in this question, it's a combined strategy. You will find out whether you are a net premium payer, net premium receivable, premium payable, and you will find out. Are you all understanding? So, for example, with regards to option selling, you have received 70 as premium. Up 70 into 2000. 14,000 is the premium receivable, correct? And as a purchaser, as an option buyer, you have to pay 50 rupees out of pocket as premium. 50 into 200, 10,000 you have to pay premium minus 10,000. Net payment or net receipt? Net receipt, okay, net receivable premium, how much? 4,000 is the premium. Are you all understanding? So, now you are having net premium receivable, payable, receivable. Point number 1, note this point. So premium receivable means you are a seller, net seller, net buyer, net seller of the option, net seller. I am net seller. I am net seller. Why this is important? I'll tell you. You will be having premium receivable of 4,000. Now, as a seller of the option, I forget about call and put option. You are a seller of the option. This you keep in mind, and 4,000 also you keep in mind. We will solve this question like this. See what happens. What they're asking: the price per share of stock after 2 months at which A should be break even. Okay, this much, these are all the option given. These are all the option given. Okay, here, again, you need to find out now. See, what you should do as a seller, what will you do? Very simple here. Net seller, how much is that? 4,000 is the net seller. Now, what you should do first, convert this on a per share basis, which means 4,000 is the net premium received, total premium this is. Up a premium, okay, on a per share basis, divided by 200, because this 200 is the lot size. How much you will get? 20 you will get. Are you all understanding? Clarity is there. 20 you will get. Understanding? 20 is the net premium. The point is, sir, whether I should consider this or consider the strike price minus premium, strike price plus premium. See, I'll first discuss the correct solution. Then I'll discuss what is the flaw in this question. Okay, none of the option is correct. You need to identify whether this extra selling you did, 20 rupees. This is from call option or put option? Call option. Are you all understanding? So, extra, you are selling 20 rupees is net premium receivable, which means net seller. Net seller of call option or put option? Call option. Which means net seller of call option. What formula you should apply? Okay, which means this is strike price plus premium. Strike price plus premium. Here, what is the strike price of the call option? That you should consider. You are net seller of the call option. Call option strike price is 1,500 plus 20 rupees. 1,520 should be your answer. 1,520 should be your answer. Interestingly, none of the answer matches, and what I don't know what they've done. See, what the question, case scenario number 10, they've given us A as the solution, which is 1180 is completely wrong. Okay, it's totally wrong. I'll tell you why it is wrong. I'll just try to, illustrate. Now, what I have to, let us take this one and verify whether this is break-even FSP or not. 1,520, assume is the break-even FSP. Future spot price becomes 1,520. Shall we verify? We have call option, we have put option. Okay, call option, you are buyer or seller? You are buyer of the call option, seller of the call option. Now, a share worth, here you are buyer of the put option. Now, a share worth 1,520, what will you do here? A share worth 1,520, you have, holder will have right to buy at 1,500. Will he exercise and buy? Yes, he will exercise and buy. Are you all understanding? Share worth how much? 1,500. 520. FSP is 1,520, which is break-even FSP found out by us. Agreed? 1,520 share worth 1,520, buyable at 1,500. Will he exercise? Yes, the holder will exercise. Then, what will be the payoff for holder? 20 rupees, which means loss for us. 20 rupees will be the loss for us. Are you all understanding? So, from call option selling, I will be having a loss of how much? Payoff, how much? Loss of 20 rupees into 200. Let's say 20 rupees into 200, now 4,000 I will incur loss. Okay. Why? This is payoff loss, 20 into 200. Agreed? But I have sold, not bought now. Appa, I will receive premium also. How much premium I will receive? 70 into 200, 14,000 premium also I will receive. So minus 14,000 plus, minus 4,000 plus 14,000. Net, how much is there? 10,000 gain. Are you all understanding? This is there. But I have taken only call selling. Put buying also I have taken position, put option also. Let us check. Here also, a share worth 1,520. Right to sell at 1,200. Will I sell? Will not sell? Will I sell? Will not sell? Will not sell. Are you all understanding? I will lapse the option. So I will not get anything from the call buying. But I will have to pay the premium. 50 into 200, 10,000 into 200. Okay, I don't have any benefit, but I will have the cost. Loss is how much? 10,000. By 50 into 200. 50 into 200. How much is this? 10,000. Are you all understanding? So this loss and this will be offset. This is the net position will be 0. Net payoff will be 0. So 1,520 is the correct solution. Are you all understanding? 1,180 it will never match a wrong answer. That is why, see, that's why I'm very skeptical about this IC. They've given the wrong option. There is no correct option. Apart from that, they've also given the wrong choice in the question, which makes me terrified. I don't know how. Anyway, what to select, I don't know. Yeah, but 1,570 now we can assume that 70-20 is wrongly written as 70. Here, I don't know. They've given some justification, stupid justification for 1,180 also. It's completely wrong. Anyway, third question. Okay. See, I'm just rubbing this off. You take question number 3 here. Assume that the contract size of each option contract is 300 and the price of G limited share after 2 prices to 1,600. The net payoff of A will be, okay. See, here contract size they have changed it to 300 and the future spot price is 1,600. A share worth 1,600. Right to sell. You have taken call option selling. Right to sell at what is that? Right to buy at 1,500. Holder will exercise. 100 rupees will be lost for you. 100 into 300. How much is that? 30,000 will be lost from selling, but you will receive premium minus premium. Premium you will receive now. This is loss. See, loss I can put like this. Premium you will receive. How much will premium? Assume that 70 will be the premium same. So 70 into 300. What is that? 21,000 is the premium receipt. So net loss is 9,000 from here. Then I go to the put option buyer now. How much share worth? 1,600. Right to sell at 1,200. I will never exercise. I lapse it, but premium I have to pay. How much is the premium? 50 I think is the put option premium. 50 into 300. How much is that? 15,000. So this is loss 15,000. This is also loss. Yes, premium receipt 15,000 plus 9,000, 24,000 loss. Any option is there? Yes, 3A is the right answer, I believe. Okay, 3A, 24,000 minus 24,000 is the loss. That is correct. That answer is correct. Okay. Now from case scenario number 11, we will discuss in the next video.